This is Scott Becker with the Becker Private Equity and Business Podcast. Today's discussion is three signs that we're headed to Armageddon. And bear with me, and you might think that's hyperbole, but bear with me as I try and explain it. So we've got ourselves as a nation to we're at about $36 trillion in debt. The annual deficit's about 1.8 trillion. There seems to be no real hope in store, whether it's President Trump that's elected or Vice President Kamala Harris that's elected. Neither one seems to be particularly serious about taking on the national debt. Now, if you got that kind of national debt and you're funding and super fueling the economy with that kind of debt, you ought to be in a spot where you're seeing great growth. And quite frankly, at $1.8 trillion in deficit, you also better be seeing some inflation. So here's the other two signs. The first sign that Armageddon's upon us, the debt has risen to $36 trillion or so, $1.8 trillion a year. That's incredible. Second, the U.S. economy grew in the third quarter a little bit less than expected, 2.8%. And the context is here. If you're spending 7 to 8% of your economy on deficit spending, you better get growth of better than 2.83%. It means for all practical purposes, you're like a poker player leaving his money on the table. It's like not bargain shopping, just buying everything off Amazon, not even thinking about bargain shopping at all. It's just leaving money on the table. It's like when somebody goes to the fancy local grocery store, foodstuffs versus just getting stuff at Mariano's or something like that. It's just leaving money on the table. And that's what the U.S. government is doing with its $1 trillion deficit and 3% growth rate. It's like seeing another pair of tennis shoes in the house that aren't really needed. That's what you're seeing with the deficit spending and only that much growth. The second sign that Armageddon is upon us is the fact that you've got the lower growth rate to go with huge inflation. And then you've got with huge deficits. And then you've got inflation slowed in the last quarter. It slowed to 2.2%. That's good news because it might allow Chairman Powell to take his foot off the pedal on the rates and reduce rates a little bit further. And the markets are responding positively to that today. At the same time, you got a situation where the debt is getting so high, yields are going back up, because the U.S. just can't sell the amount of Treasury bonds at the pricing that would like to sell them. At some point, you get yourself in trouble. You give up control of the game because you've got too much deficits, and thus the bond markets make it harder or more expensive to sell that debt into the markets. And that's exactly what's going on. So we've called this three signs that Armageddon is upon us. Huge deficits, growth that's less than half of those deficit spendings. That's horrible. Inflation going down. And in a lot of ways, it's a good sign. It means the markets are being buoyed today. But it's also a challenging sign because it means people don't have money to spend, even though we got these crazy, crazy deficits. And then finally, a situation where the U.S. is finding it harder to sell their treasuries because people don't view it as a safe an investment as it should be or as it always was. So the rates on those are going up. Reminds me of high-end credit cards we try not to allow in the Becker household. Thank you for listening to the Becker Private Equity and Business Podcast. Anytime you have a suggestion, a topic, an idea, 773-766-5322. As always, thank you to Chanel Bunger, our wonderful producer. Thank you very much.